Opendoor is the leading iBuying company that provides an e-commerce-like experience for people to buy and sell homes. The stock has been incredibly volatile lately, dropping as low as $1 a share to rallying as high as $5 a share this year. And recently, the stock rallied more than 80% in a single month, but despite the rally, the stock is still down nearly 70% from its all-time highs. So the question is Opendoor still a buy here? Well, that's going to be the topic of today's video. I'll be going through Opendoor's Q3 results, valuation, and what I think about Opendoor stock moving forward. As always, you can find the link to my article in the description box below, and with that out of the way, let's jump straight in and take a look at Opendoor's Q3 results. Jumping right in, Opendoor's Q3 revenue was $980 million, down a whopping 71% year over year and 50% quarter over quarter due to lower sales volumes and lower home prices, which was down 8% this quarter. Despite being in line with management's guidance of $950 million to $1 billion, Opendoor's Q3 revenue fell short of analyst expectations by $30 million. But as you can see, Opendoor completely erased all the growth it enjoyed during the early days of the pandemic, back when the housing market was booming due to lower interest rates. But today, rising interest rates, spiking mortgage rates, and the housing market reset last year is putting tremendous pressure on Opendoor's operations, which is why the Opendoor business declined substantially after almost doubling year over year in 2022. So here you can see how many homes Opendoor bought and sold over the last few quarters, as well as the number of homes in inventory at the end of each quarter. As you can see, due to the housing market reset, Opendoor has been slowing down its pace of home acquisitions in 2022 as the company was focusing on selling more homes, specifically to unload the homes it acquired at peak prices, also known as the Q2 cohort or the old book. But now Opendoor is ramping up home acquisitions again, with Q3 homes purchased up 17% sequentially to 3,100. On a year-over-year basis though, homes purchased is still down 63% year over year. Moving forward, homes purchased should increase over the next few quarters as Opendoor continues to increase distribution through its channel partners like Zillow, which is now live in 45 markets, as well as eXp Realty, which Opendoor just signed a new partnership with. And this is an important partnership because eXp Realty is the largest broker by transaction volume. So this is going to bring a lot of business for Opendoor. In fact, Opendoor is already seeing strong traction among channel partners, with acquisitions from its partnership channels increasing 33% quarter over quarter and are up over 76% compared to Q1 this year. So I expect these partnerships to expand further, which should drive growth for Opendoor. On the other hand, Opendoor sold fewer and fewer homes, largely because the number of homes in inventory keeps dropping in the last few quarters, as Opendoor has been a net seller of homes since the company is focusing on clearing its old book of inventory. So Opendoor has less homes to sell, and that's why homes sold continues to drop sequentially, with 2,700 homes sold in Q3, which is down 68% year over year. However, if you haven't noticed, Opendoor was a net buyer of homes in Q3, which is why homes in inventory expanded sequentially to slightly over 4,000. And as Opendoor rebuilds its inventory in the next few quarters, we can expect more homes sold in the coming quarters, especially during the hotter seasons in the first half of 2024. And this should boost revenue numbers moving forward. Nevertheless, the current macroeconomic environment and housing market continue to be a challenge for Opendoor. For example, mortgage rates are still as high as 7 to 8%, which is just too expensive for most people. However, during these difficult times, I think customers want speed, transparency, and certainty, which are all qualities and features that are not available through the traditional way of buying and selling homes. As such, I think more and more customers will turn to Opendoor, which allows Opendoor to gain even more market share. And in fact, this is already happening, which is a testament to the company's value proposition. And when the Fed begins to cut interest rates, which is very soon in my opinion, I think demand will pick up once again, and this should drive strong growth for Opendoor. Looking at profitability, we can see what the company's contribution profit looks like over the last few quarters. Contribution profit is the company's preferred metric to assess unit economics, and it is basically gross profit minus direct selling and holding costs and any inventory valuation adjustments. As you can see, contribution profit finally turned positive after being negative for a full year, as you can see right here, which is really great news for investors. In Q3, contribution profit was 43 million, representing a contribution margin of 4.4%, and this actually exceeded management's guidance of 3.2% to 4% due to the strong performance of their new book of homes and lower than expected sales from the old book. It's not back to where it was, and it's not back to management's annual contribution margin target range of 5 to 7%, but things are trending in the right direction, and I think we'll see at least 5% contribution margin in the first half of 2024, where it's seasonally strong for Opendoor's margins. Moving on, Opendoor's improved contribution margin was due to favorable inventory mix. Specifically, Opendoor sold way more homes from the new book as opposed to the old book. As you can see, Opendoor sold 441 old homes at a contribution margin of negative 17.4%, while the company sold more than 2,200 new homes at a contribution margin of 9.2%, which led to an overall positive contribution profit of 43 million or 4.4% of revenue. In addition, as of the end of Q3, Opendoor has less than 150 old book homes not in resale contract, which means minimal margin pressure from the old book moving forward. In other words, expect contribution margin to improve from here as the higher margin new book of inventory makes up the majority of revenue. In terms of the bottom line, both adjusted net income and adjusted EBITDA are looking better as well. In Q3, adjusted net income, which is the best proxy for Opendoor's operating cash flow, was negative 75 million, which is a negative 7.7% adjusted net margin. On the other hand, adjusted EBITDA was negative 49 million in Q3, ahead of management's guidance of negative 60 to 70 million due to stronger than expected contribution margin as well as operating leverage. Again, both metrics are improving, which is great to see, and hopefully we'll see these metrics return to positive very soon, just like what we saw in Q1 and Q2 last year. As you can tell, profitability continues to improve as Opendoor continues to dispose its lower margin old book of inventory and sell more of its higher margin fresh inventory. By Q4, the old book should be gone, which clears the way for Opendoor to return to adjusted net income profitability. In addition, the housing market is stabilizing and the company is taking a balanced approach towards growth and risk management, so profitability should only get better from here. Regardless, improving profitability and actually being profitable are two very different things, and as you can see, Opendoor is severely unprofitable, and the only way for Opendoor to achieve profitability is to rescale its business to cover its large fixed costs. Turning to the balance sheet, Opendoor has $1.2 billion of cash and short-term investments with $2.9 billion of total debt, placing its net cash position at about negative $1.7 billion. As shown here, net cash has been improving over the last few quarters as the company improves its cost structure and slows down the pace of home acquisitions. However, as the company scales, I expect net cash to drop as Opendoor would have to raise capital to fund home purchases. Opendoor's inventory situation is looking better as well. As of Q3, Opendoor holds less than 150 homes from the old book, worth about $82 million, which is down from $254 million in Q2. The old book now represents about 6% of total inventory balance, down from 22% in Q2, so this is really good progress for the company. It's also worth noting that as of Q3, 12% of Opendoor's homes had been listed on the market for more than 120 days, and if not for the old book, that figure would have been 8%. Regardless, Opendoor's turnover rate is much better than the broader market's 15%, which is a testament to Opendoor's value proposition and speed of execution. In terms of cash flow, Opendoor had free cash flow of negative 227 million, which is a negative 23% free cash flow margin. As you can see, free cash flow turned negative after 3 consecutive quarters of positive free cash flow. This negative cash flow is expected since Opendoor was a net buyer of homes in Q3, whereas in the last 3 quarters, Opendoor was a net seller of homes. But moving forward, I expect Opendoor to be a net buyer of homes in the next few quarters. In other words, expect more negative cash flows in the coming quarters. Turning to the guidance, management expect Q4 revenue of 800 to 850 million, which is a 71% year-over-year decline and a 16% quarter-over-quarter decline. The drop in revenue quarter-over-quarter is due to high mortgage rates, lower market clearance rates typical in Q4, as well as reduced home-level list prices. As such, contribution profit is expected to fall as well to about 15 million to 25 million. This implies a contribution profit margin of around 2.4%, down from Q3's 4.4%, but still an improvement from last year's negative 7.2%. And finally, management expects Q4 adjusted EBITDA to be about negative 100 million, implying a negative 12.1% adjusted EBITDA margin, which is lower than Q3's negative 5% margin, likely due to lower revenue and contribution profit. While Q4 guidance looks weak, management expects to accelerate home acquisitions in 2024 as the company reduces spreads, expands with channel partners, and increases marketing spend, which should subsequently accelerate revenue growth. More importantly, management reiterated that they expect to return to positive adjusted net income at a steady annual revenue of $10 billion. When they will achieve this is not specified, but I'm guessing 2025 will be the earliest that they'll turn profitable. Regardless, I have zero doubt that Opendoor can return to $10 billion of annual revenue. For one, the residential real estate market is a 1.9 trillion industry, which means that Opendoor only has less than 1% market share. More importantly, Opendoor has a proven track record of capturing over 4% market share in multiple markets. And since 2019, Opendoor has quadrupled its serviceable addressable market via market and buyback expansion to $600 billion. So assuming just a 3% market share within its current serviceable addressable market of $600 billion, which is more than reasonable, Opendoor should generate at least $18 billion of revenue, and at that point, Opendoor should be profitable. It won't be easy by any means, but given the fact that iBuying market penetration is less than 1%, given the fact that Opendoor is a virtual monopoly in the iBuying space, and given the fact that Opendoor has a far superior value proposition compared to traditional real estate agents, I think Opendoor is well positioned to gain market share and grow and eventually turn profitable once again. In terms of valuation, Opendoor still trades at depressed valuations at only 0.4 times EV to revenue, which is a massive discount to its peak multiple of 7.6 times and its average of 1.9 times. So from a historical standpoint, Opendoor stock still looks attractively valued. On the other hand, I'm lowering my fair value estimate on Opendoor stock from $7.88 to $5.15, mainly because of lower revenue estimates. I think I was too aggressive with my assumptions, and I think management will take a much more cautious approach to growth, which is why I'm lowering my revenue estimates. If you're interested in learning more about my DCF model and how I arrive at this intrinsic value, you can check it out in my article, which I will link in the description box below. That said, my price target is significantly higher than the average analyst price target of $2.29. In addition, my price target represents an upside potential of 55% based on the current price of $3.32. Looking at the technicals, we can see how Opendoor's price action looks like, and I can tell you right now that I think the setup for Opendoor stock is quite bullish. First, the stock is showing bullish divergence in both the MACD and RSI indicators. As you can see, the stock was making lower lows. However, the MACD histogram and RSI was making higher lows, which means that momentum to the downside is weakening and that a reversal is likely. Secondly, the stock bounced perfectly on this uptrend line right here, with the last bounce happening right at Q3 earnings. And since then, Opendoor stock rallied more than 80%, and this price movement is really important because Opendoor just broke 3 major resistance levels. This includes the 50-day simple moving average, which is the yellow line right here, and the 200-day moving average, which is the orange line right here. And this is bullish because it shows that the primary trend is now up. In addition, if you look at the bars in the right side of the chart right here, this is a technical indicator called volume profile. They are similar to the volume bars that you see down here, but instead of showing how much volume is trading on a specific day, the volume profile shows how much volume is trading based on a specific price and time frame. And as you can see, the indicator shows that the most volume, as indicated by the longest bar right here, happens at around $2.50, and that means that $2.50 level was a major resistance level. And since the stock broke past that price level, it is now a major support level. And as you can see, there's not much volume above $2.50, which means that there's little resistance for further upside. At the same time, we just saw a massive green candle, which means that the bullish momentum is very strong. And as you can see, whenever there's a large green candle, a continuation of that price action usually follows. So I think a lot of indicators are showing bullishness for Opendoor, so I'm expecting more upside for Opendoor in the next few weeks or so. And let's not forget that Opendoor has a short interest of 13%, so a short squeeze in the near future is very likely. In closing, my investment thesis on Opendoor remains unchanged. I think Opendoor has a long growth runway ahead due to the fact that the company has a superior value proposition, is a virtual monopoly in the iBuying business, and has only 1% market share in an industry that is worth almost $2 trillion. Yes, the company has been dealing with some major challenges, including high interest rates and a housing crash, which forced Opendoor to sell a lot of homes at huge losses. However, Q3 proves that Opendoor is on the right track to rescale its business and eventually turn profitable once again. This includes the return to positive contribution margin, being a net buyer of homes in Q3, and also expanding its partnership with channel partners. Furthermore, technicals look bullish for Opendoor, which could push the stock higher from here. Put simply, the growth story and investment thesis remains intact, which is why I continue to hold Opendoor stock. And with that in mind, that is all that I have for you today. If you find value in this video, please leave a like, comment, and subscribe to my channel for more investment content like this. As always, I appreciate you and I hope you have an amazing day. See you guys in the next video.